complex valuations which he's done, I have personally witnessed many, and I have worked with him on a continuous basis. I work with him on a continuous basis. Rajesh, having you here to start with, I think this is the first session which we are going to have, but I think going forward, we are going to run a series of sessions on valuation. And as rightly said, when valuation, whether it is a buy side or sell side, it's the interest. Who is the seller or who is the buyer? Who has the interest whether to buy or to sell? We had in Hyderabad one very good valuation of Paradise Biryani, which was like again, one of the location was being purchased by him, and the value was been fabulous for just buying out the space where the other guy was operating. And the kind of exposure which you have, Rajesh, I think is fantastic with regards to India, US particularly, and the kind of transactions you have done on behalf of Pyramidal, you have done on behalf of L&T, you have done on behalf of so many organizations I can continuously talk about in more than one ways. Mahindra and Mahindra, you have done a great job in that area. And there are many such things. So friends, having Rajesh is going to be a great pleasure. And when he is going to talk about valuation, I'm promising you one thing. It's like, Raju, तुम्हारे दांत तो मोतियों जैसे चमकते हैं. So it's basically, he's उगलने वाले हैं मोती. So he's going to pour out pearls when he's going to talk about valuation. That is the assurance I can give you. Friends, there is a beautiful article today which has come in a Mumbai newspaper, where it says with trillions in moratorium, billions would be NPAs. This is the story of India. And unfortunately, with the kind of situation where we have gone in the COVID times, what is going to be tested again and again is on the valuation side of the properties, collaterals, the valuation of all things, whether it is a business, whether it is, any form of asset which is being given. And today we all know huge amount of example. I'll tell you, I was working on a particular client with regards to LRD, and the entire proposal went up to a particular level, and they said, wait, we would like to reassess what is the status, and 2 months we would like to see whether the rents are going to come or not. And unfortunately, a transaction of 1,500 crores actually got shelved within 2 months. So just imagine the kind of impact which is going to go through the entire process. And today we are in the world of IFRS, which is primarily all the large organizations. All the large organizations are subject to fair value. And when you talk about fair value, automatically the valuation has to be tested every year. This process is going to be evaluated not only at the international level, also at the country level. And all the subsidiaries, holding, individual companies, foreign assets, everything is going to be reevaluated. One side of the story looks very positive with regards to the new investment coming into India. But the other side of the story is how difficult it is going to survive with regards to the existing businesses. There are lots such things which we can continuously talk upon, and I'll be loving to talk about a lot of things which is happening around the Indian economy sometime. But the fact goes very simple: the valuation as such is going to be very critical. Friends, a lot of people have qualified their valuation exams, but the fact goes very simple: we are underpricing our services, which I think personally, don't do that mistake. It is going to really hit hard in times to come. I'm not, getting a fear in mind, but I'm just talking about a reality where people have done valuation for might be 25, 30,000, 50,000, a lakh of rupees, where the same would have been actually much more than that. We think that, sometimes the valuation is not going to be looked by anyone, but the kind of review mechanism which is happening, that review mechanism is becoming very critical even from the RBI point of view. All these assets are getting into more critical zone. When you talk about NPAs which are going to be reported, now we are not able to do it, but going forward it is going to be huge. If you start talking about one side of the story is when foreign investments is going to come into India, there will be a lot of assets which will be lying in India to buy out. But the fact goes very simple: is that a good story to talk about? I don't think so. Somewhere sometime we need to be really very calculative in our discussions. So, listening from on valuation from Rajesh will give you a different perspective altogether. And I think huge amount of value add which is going to come from Rajesh. And I'm going to sit and listen to Rajesh because I love to listen to him, not only on the valuation side, but also as a friend, as a, as a brother, and as a partner. He's sometime a fantastic person to work with. So I have been associated with him on various forums, though we are not directly partnered, but on assignments we have worked together. So that makes whole lot of difference. And today to have Rajesh is going to make whole lot of difference. So over to you, Pankaj Bhai, again. And I am also going to listen to the great scholar on valuation. And believe me, the kind of people he's trained, youngsters. I'm not joking, Pankaj Bhai. If you go and see the team which he has developed in Mumbai, you'll go berserk. That is the kind of contribution he's made and he's continuing to make. So I look forward to listen to him more. Thank you.
Thank you. Thank you, Daya.
Thank you for the introductory remarks. Devai, itna bol diye ki I don't think anyone would like to wait to listen to Rajesh Bhai, but still as a formality, Deepak, a quick introduction of Rajesh ji before Rajesh ji takes over the session.
Good afternoon, good evening, everybody. The words which have been said by our Central Council member Dayanivaji Sharma towards the introduction is only a drop in the ocean. His academic qualifications are superb. It is my really pleasure to introduce CA Rajesh Khairajani, the man who has already done more than 500 valuation in just a span of 12 years. Doing, first of all, valuation is such a specialized subject, and getting so many valuations done is really a great professional achievement. His academic qualification: he is a chartered accountant, he is an accredited senior appraiser and a member of American Society of Appraisers. Rajesh is also qualified as a US certified public accountant from the Delaware State Board of Accountancy. He is a member of American Institute of Certified Public Accountants. He is accredited in business valuation ABV exam from the AICPA, a highly sought after academic credential. He holds a master degree from University of Mumbai. Apart, his area of service includes basically he has done Indian multinationals having business interest in USA, Canada and UK, operating in the pharma and ITES segments. Business having entrepreneurial growth stories across a wide range of industries to measure and enhance shareholder value. His key service area includes purchase price allocation as per Ind AS 103, impairment testing as per Ind AS 36, ESOPs valuation, valuation of intangibles, valuation of financial instruments, SBA valuation, and so on and so forth. He has given articles to almost all the practical subjects, ranging from discount rate, building a discount rate from early stage, valuation of non-compete agreements, valuation of deferred revenue, and the list is unfold. Apart from this, Rajesh is also a regular present papers and a regular speaker to various conferences, webinars, and seminars organized by NASUCAM. With this, I hand over the session to Rajesh sir. Thank you, sir. The list is very long. I'm sorry I had to cut it out because of the time, because the members would like to listen to you more. Thank you.
Thank you. Thank you. Yeah, I think.
Rajesh Bhai, just 1 second, Rajesh Bhai.
Sure.
I'd like to once again welcome all the 132 people here, and I would like to say that some of you are raising hands. Look, most of the times when we ask them, it is by mistake only. So if you have to talk anything, let Rajesh Bhai first finish it, and then at the time of question answers, if you have some more question, then you raise the hand and then put it in the chat that we have additional question. Then I will unmute you and you can talk. But now suddenly if you raise hands, I'm sorry friends, in this type of webinars, we cannot allow each one of you to talk. So any raising of hands only, that too after your question, if you have a subsequent question to the question asked by you. Thank you very much. Sorry, Rajesh Bhai, you can continue.
Sure. I hope I'm audible.
Yes.
Thanks a lot. Thanks a lot for the kind introduction, and thanks Daya. I really miss those days of going to the club and having some fantastic meals along with the biryani in Hyderabad. So I hope that we will come back to that day sooner than later. But thank you very much. Thank you for having me here. Um, when Daya and myself started discussing about doing a session on valuation, we were discussing as to what really needs to be put out there. And then we finally decided to roll out what we've now called as a primer on valuation. This being more of a primer, we would like to take on a broad range of topic and possibly set the tone for some in-depth discussion on specific topics in the future based on what is the kind of a feedback or what is the flavor of the season. Let me quickly, I'm just going to, okay. All right. Um, Let me, quickly just kind of take you over what we are going to cover. We would start with our discussion on how the business valuation profession is shaping up in India, and then also talk about the various avenues that's available to you as a professional who is practicing valuation. We would look at some of the most commonly used approaches and valuation and the methods for valuation. These approaches and the valuation method could be used for companies that have been in existence for 10 odd years or have just commenced operation. So the methods that we will cover would essentially be good enough for you to do any kind of valuation if you are practicing valuation. We would be talking about the income approach and the market approach, and we would be talking about various methods under those approaches. We will also talk about any nuances, specific nuances, which you should be aware of when you're valuing companies in the early stage of their life cycle. Um, the other concept that we would be discussing would be the concept of control premium or a minority value. That would be covered in the topic which we have put out there as levels of value. We would also look at the valuation requirement from, a financial reporting valuation requirement on the basis of Ind AS or IFRS or US GAAP. Luckily, what has happened is that because of the convergence between the three gaps, more so in Ind AS and IFRS, US GAAP, there are still some scope exceptions, but the learnings from one can be very easily be adopted and used in the other. So if you are doing valuations for Ind AS, you may very well use the same learnings for doing valuations for IFRS and even for US GAAP. So that's the great thing that has happened because of the convergence of these standards. We would also look at, what has been the impact of the COVID-19 pandemic on um, on the valuations, and we would have an open discussion on that. I have some thoughts. We've actually done most of our valuations for companies for the December reporting in the United States and even for the March reporting in India, and we have some lessons that we can actually discuss and get your views as well on that. Okay. And now, before I go into the various opportunities that's available to you as a valuer today, I would say that most of y'all would have read the Valuers Bill 2020, the exposure draft which was shared, and I think that it's a step in the right direction. If you ask me, I would like to have a scenario wherein all the regulation basically talk about one de facto body, which is the body which will regulate and govern the valuation profession in India. Because today we've got a separate slide which we will be going over. If you want to do a valuation, you need to first understand, okay, fine, who is whether it's a chartered accountant who will be issuing this opinion, or whether it's a registered valuer, or whether it's a category one merchant banker. So I think that when the IBBI took this over and said that, okay, fine, we will have RVOs and RV doing valuation training. Still I see that there is a room for improvement. But I think that with the National Institute of Valuers, I think it's a step in the right direction. Now, with that, what you see on the screen is the various opportunities that's available for one who is practicing valuation. You know, if there is, you know, any kind of cross-border funds going out of the country, which requires FEMA or an RBI approval, there is a valuation requirement for that. If you are doing any kind of restructuring, so, you know, the income tax also calls for valuations. So is the, you know, the insolvency and the bankruptcy code requires valuation as well. The Companies Act is something which, you know, talks about valuation, and that's where, you know, we talk about financial reporting valuation, because, you know, that's where, you know, the Companies Act make a reference to the Ind AS. And when you look at Ind AS, now, because India has adopted Ind AS, the historical cost convention, which used to be the norm before the adoption of Ind AS, is no longer the norm, because most of your transactions, so let's say if there is a merger and acquisition where there is an M&A happening between A company and B, and if the business combination standard is applicable, you would have to prepare your opening date balance sheet, and you would have to issue a report which is known as a purchase price allocation report, which means that not only your uh, tangible assets are fair valued, but also you would have to value your intangible assets and get them onto the balance sheet. So that's your purchase price allocation. Subsequently, a year, if there is an annual you know, impairment requirement, or if there is a trigger, then you would have to test those specific assets also for impairment. Okay, those could be long lived assets, or you know, your plant machinery equipment, as well as the intangible, as well as the goodwill would be tested for impairment. Many a times, and now, you know, there are a lot of transactions which have happened, which is, you know, Series A, Series B, and some of those have used instruments which require fair valuation, because it's a convertible instrument which has been issued, or a redeemable instrument which has been issued, which requires fair valuation. So that is something that, you know, is a specified, a specialized area which one can definitely pursue. ESOP, you know, gone are the days where the compensation cost were being recorded at intrinsic value. Now you require a fair valuation for all your stock options. Now, whether be it stock options, stock appreciation rights, you know, RSUs in the United States as well. So most of them, which have you know, um, uh, categorized as an option, would be requiring fair value. So you would use your Black-Scholes model, whether you will be using your you know, binomial lattice model, or using a Monte Carlo simulation. So that is something that requires valuation. Um, on this slide, most of these transactions are basically, you know, which we have been asked upon, that, hey, you know what, we are this you know, 100-year-old family, you know, we are running this business, this food chain business, but we are now, you know, looking to split our family business. Can you do a valuation? So that's where a requirement of a valuation is, which we call it as a family settlement. Litigation many a times requires valuation. We just recently just, you know, closed my call with one of the attorneys which required a valuation. So this is something that, you know, we have been you know, asked upon by our clients and by our contacts, saying that, okay, fine, you know, can you help us in doing a valuation? Just last week on Thursday, I was on a call with another attorney in the United States. They wanted, basically, he wanted a valuation report for his client for his visa filing. So this was a Mexican you know, company which was looking to which was looking to acquire a business in the United States, a 50% stake which he wanted to buy, and that required valuation. So the point that I'm trying to make is that the avenues are many, right? And because of now the discussion being made on valuation, this could be something that, you know, this obviously is a full-time practice area for me. You know, I practice valuations full time, but this is a fantastic opportunity and a fantastic time to be in, if you're looking to kind of you know, cross the bridge and say that, okay, fine, you know, I want to be a valuation professional practicing valuation in India. Now, this is something which I thought might be helpful to all of y'all. This also serves as a ready checklist for me when we are doing valuations. So, you know, when you look at a transaction, right? And if there is a transaction which is in the works, you don't have a ready-made answer. Okay, fine. Okay, this is a transaction, and for this transaction, who will be issuing a valuation report? Many a time, so this is, this is basically a sundry list. There could be more, but I would say that many a times what happens is that if there is a transaction which is in the works, the FEMA might actually require a valuation from a category 1 merchant banker, but for the Income Tax Act, you might be requiring a CA certification. For accounting purposes, for Ind AS purposes, you might be requiring a valuation, by a registered valuer. So, and many a times what happens is that even if the inputs are the same, the value conclusion may differ. So, we've just faced this practical, difficulty wherein, our valuation was X, and, the merchant banker's valuation was something else. And, we were kind of issuing the report as of the same date. But then obviously, so there was this practical difficulty, which finally got sorted. But if there is one, the National Institute of Valuer, which says, okay, fine, and the Income Tax Act subscribe to that, the FEMA regulation subscribe to that, all of them, then basically talk that this is a valuation by a member, which is with the NIV, and this is the valuation report. So I think that is something that will be, really welcome. And it really helps corporate as well to make life simpler for them when they are doing transactions. This is the valuer bill. I think if you have not had a look at it, I would urge. It's, I think, around 160 odd pager document. I would definitely urge you all to kind of go over it, and kind of we've as a firm sent our comments already. But I think you should definitely have a look at it. Many a times I get this question as to what is the current, registered valuer scene like in India, and so this is where we are currently. As you all know, the ICAI is also RVO at this point of time. So I think the last I checked, there were around 7 registered valuer organizations. There might be more now, but what it means is that now valuation is not just left for practicing chartered accountants, but there could be professionals from other discipline as well who could come and do valuation. So that is something that is definitely out there. Definitely, I would say that we being as accountants, our grasp of the balance sheet, of the income statement has been, I would say that we've looked at these statements for some time, so it becomes much more easier for us to okay, fine, make judgments, valuation calls. But the point to take from this is that uh, you know currently it's with the IBBI, and this is kind of a passing phase. It eventually will be resting with the NIV. So that is what the situation is currently. When I was doing the registered valuer examination, and when our firm was applying for this, at that point in time, they did not allow corporates to be registered valuer. So it was more of a LLP. But I think now they've also changed, and now even corporates or companies can also be registered valuers. Okay, so you know when you look at the valuation approaches, and actually speaking, there are 3 valuation approaches, right? So there is the market approach, the income approach, and the asset approach or the cost approach. I'm just going to minimize the screen. Okay, it's blocking my content. Hang on. Okay, right. So these are the 3 approaches, and if you look at it, if you focus on the market approach and the income approach, I would say 95% of all valuations can be done if you are having a grip of these 2 approaches, right? There would be, that 5% of a case wherein you would be requiring to do valuation based on a cost approach, because let's say, the going concern issue is probably, under question, or, those are basically assets which are, simply having a large amount of value. in property, plant, and equipment, and probably the cost approach might be the best approach to to employ. But generally speaking, if you ask me, for most of our valuations, we have been using the market approach and the income approach, and under that, we've been using a couple of methods over there. All right. Now, a question that we get many a times is that I am doing a valuation and I'm using an income approach. And based on an income approach, let's say I'm using a discounted cash flow method, and my valuation conclusion and the other valuation conclusion used by the usage of a market approach, the delta between them is almost 40%. So what do I do? So to answer that question is that it's, if there is a value divergence between the two methods, I would say go back and check your inputs and see where you have probably overstated a number or understated the other number. And generally speaking, a 5 to 10% deviation between the two methods is acceptable. If there is a deviation of, let's say, 40%, like what I said, that means go back to your assumptions, check what's happening. It could very well happen that you've done a discounted cash flow model, and because of this particular intangible that that company is creating, which is not known to the market, because the market prices it based on the information which is knowable to them. Now, you could be, let's say you're a pharma company and you've done some clinical trials and you've had some fantastic results, and that in a year's time you will be releasing this drug out in the market, and then obviously you'll have a separate growth trajectory which is not really known into the market. So that's why the market is not pricing it. Now, if that is a situation, you would still be okay in accepting that difference. If not, then you will have to make a judgment call as to whether you want to drop one of the method. Generally speaking, if it's in a close range, that is something which we as valuation professionals really like, and also I think the authorities also kind of like to see that that there are kind of two methods which is coming to the same value. Now, if I talk about in detail about what an income approach is, and in the income approach, we will be talking most of our attention. We will be putting on the discounted cash flow method. So the discounted cash flow method basically uses an income stream. Generally speaking, it's a cash flow stream, and it discounts that cash flow stream back to present value, and that's how it gets to a value. We have an illustration where I will kind of just take you through how a discounted cash flow model really works, and what are the kind of nuances that I have looked at when I'm practicing valuation on the discounted cash flow method. So and many a times what also happens is that you have to make a judgment call as to whether you use a discounted cash flow method or a capitalized cash flow method. And the answer basically lies is that whether the business has really reached a mature stage. So if a business has reached a mature stage in the life cycle, you would be better off in using a capitalized cash flow method. So let's say that if a business says that from this point onwards, I'm not going to make too much of an investment in working capital, I'm not going to make too much of an investment in capex, but I'll be just doing a maintenance investment in capital expenditure, and my growth rate will be around 5 to 6%, which is, let's say, the long term the GDP growth rate plus inflation for the country that this business is operating. You might be just better off using a 1 year income stream and just discounting it and capitalizing it and getting to a value. So that's what the capitalized cash flow model is. But now there is a company which is in a growth stage. Okay, so this company knows that they will be making these investments year 1, year 2, year 3, year 4, and subsequent to that they will get this particular growth. So in that case, the method that you have to employ is the discounted cash flow method. All right, so I think the answer lies generally speaking in what stage of the life cycle the company is really operating in. And if you think of it, the classical, corporate finance, right? Any asset is basically valued based on the income stream that it generates. right? So periodic income stream, and at the point an exit if there is an income stream. So that if you discount it to today, so that is basically the value of the assets, and this is what the discounted cash flow model really does. And one thing which I really like about it, when also they are talked about, what the situation is currently, I think that if you're looking at a discounted cash flow model, you as an appraiser, as a valuer, you are then made to listen to the story of the promoter. You are made to basically understand the business, because I always say, to my clients as well as to people who work with me, that actually a good valuation can be done on a piece of paper. What's more important is that you understand the business, you understand the business model, you understand their go to market strategy, you understand their customers, the suppliers, the whole, the from where they are, basically procuring, what's their market like, the geographical expansion, the decisions that they're trying to make. All of that then actually gets into as an input onto your discounted cash flow model. So it's more to just number crunching, but it's the story that the promoter wants to tell you that should then be translated into a discounted cash flow model. When a file comes to me for review, before looking at the model, I just sit down and try to understand, okay, fine, just tell me about the business, tell me what they are doing. And more often than not, it's the go to market strategy, along with what the industry that these guys are operating in. That's where you try to kind of gauge, and you try to make your own mental notes as to what the valuation of this business could be. Okay. uh, Also, there's this question which keeps on cropping up as to what is a free cash flows to firm and what is a free cash flows to equity. And also a question that comes to us many a times from our clients as to what is the discount rate that you are applying. And one classical question that comes to you is this, right? I think that my business should be valued at 100 crores. Okay. And you have valued it at 80 crores. The other way around, if they are using it for an income tax purposes, then they would say, what, I think that my business should just be valued 60 crores and you've basically valued it at 100 crores. Now, so what we try to then tell to the client is that, okay, fine, you're saying that you believe that's 100 crores, but that is the final number. All right. We always like to sit down with the client and say, okay, these are your inputs, right? And these are our inputs. Now based on that, we are getting to a value. So please tell me whether your forecasts are the forecast numbers that you've given us, whether that needs to be tweaked, whether your margins need to be tweaked, whether my discount rate needs to be tweaked. And more often than not, they say, what, I am getting a loan from this bank at around about 12%. Okay. And your discount rate that you've taken is, let's say, 24%. Okay. Just so let's say 12 and 18%. 24% is too divergent. So let's say that they said 12% and versus 18%. Now this is what, if your documentation of the various things that you do on your valuation model is actually broken down, it leaves a lot of judgment out of the whole valuation process. And while I say that, I will, quickly just go over what a free cash flows to the firm versus a free cash flows to the equity is. And I'm sure if some of y'all, if you're practicing valuation, you would be knowing this, but I'll just take a quick 1 minute on this one. Look at the free cash flows to the equity and free cash flows to the firm, along with the discount rate, which is the cost of equity and the WACC together. So the free cash flows to the firm means that all the cash flows that is available to the providers of equity capital as well as to the providers of debt funds. Okay, so if you're looking at your forecasts, the free cash flows to the firm, that cash when distributed will first go to the providers of debt providers, okay, as interest, and then the residual will go to the equity shareholders, okay, the equity share capital providers. So that is what the free cash flows to the firm is. Now, since that cash flow is available to both the providers of equity as well as debt, the correct discount rate to use is the weighted average cost of capital. Now, when you talk about the free cash flows to equity, now that means that the service cost, that means the interest cost for anybody who has provided debt financing has already been reduced from the cash flow. Now, if that is the case, then the correct return or the correct discount rate to be used is the cost of equity, right? So with that, if I can just draw your attention to the bottom part of the presentation, we talk about, what a WACC is. The WACC is cost of equity times the weightage of equity and plus the cost of debt. And if I can get a pointer running, okay, okay. All right. So if you look at the WACC definition, so it's the cost of equity times the weight of equity and the cost of debt times the weight of debt, right? So this is a classic weighted average cost of capital, which you would use if you're using the free cash flows to the firm. Now, like I said, we like to break down a lot of the assumptions that we put down. So it's just not an arbit number as, okay, this is my WACC. So what we do is we use either the capital asset pricing model or the modified capital asset pricing model. So as you know, the KPM is the risk-free rate plus equity risk premium times beta. Okay, so that's the capital asset pricing model. But this is useful when you're doing it's more for a portfolio. But when you are valuing a company, which is a subject company, you would add these two factors to the KPM and you would call it as a modified KPM. And think of it as an aggregator, right? So you start with the risk-free rate, then you use the equity risk premium times beta, then you add the size risk premium, and then you add the company specific risk premium. So what it does is it goes from a risk-free security, then it adds the risk of investing in the general market, which is basically the equity risk premium times beta. So these three portion together means that's a risk that somebody will be ready to accept if they are investing in the market. And then you will come down to your own company, to the subject company. You will say, okay, fine, market participants are X size, but this company is X minus minus. Now there should be a size risk premium also which should be attached, because it's a smaller company, access to capital is less, access to top management people is less, so it's kind of more riskier. So that's why there's an additional premium there. And then you talk about the company risk premium. So all of these are added together and say that, okay, this is my capital asset pricing model and this is my cost of equity. So what happens is that, remember that client who came and told me, hey, you know what, my debt fund is 12%, why have you done 18%? I would sit down with the client and I would say that, hey, you know what, this is what I've done, and on the basis of this I have got my weighted average cost of capital as 18%. Now please tell me that what needs to be changed. And if you do this more often than not, the discussion will go away from the capital asset, from your discount rate computation, because all of these, the risk free rate, the equity risk premium, the beta, the size risk premium, and the company specific risk premium, you have not, except for the company risk premium, okay, other than that, all of those are something which is observable data. It's not something which is, it's your judgment call. So I think if you're able to break it down, that really helps. And on an Indian scenario, the risk-free rate, generally speaking, we take the 10-year yield on the government, on the RBI bonds. The equity risk premium is something that you can actually calculate. You basically look at 20 years of market return, which is the annual return that the market gives over the risk-free rate. The difference of that, you can just take an average for 20 years. That is essentially your equity risk premium. There is also a built-up method, right? Many a times what happens is that, that people, practitioners don't really want to kind of compute the beta, but the industry risk premium then is a proxy for beta, right? We used to predominantly use the built-up method for all our valuation. We've kind of moved to the KPM, and we kind of try to corroborate our KPM built-up with the built-up model. Okay. What I will do is I'll toggle between this slide and the other slide. We will just quickly go over, the way in which we really, do our DCF model. And I'm sure, you would probably have a different way of doing it, but this is how we do it. So we'll just quickly, walk you through it. And if I can just quickly go over this. So it the first thing is projecting the operating results and the free cash flows of the business over the forecast period, right? So this is where I'll just go to the next slide. Okay. All right, so this is where now if you look at this line over here, the free cash flows to the firm, right? So this is what I was talking about. Because I have the free cash flows to the firm, I would be discounting this. The present value factor that I'm using here is the weighted average cost of capital. If this would have been a free cash flows to equity, I would have been using here the cost of equity nonetheless. So what is happening here is that this is the standard, kind of a layout that we see for all our valuations. And we have the revenues, which you can see this company from an 8 million, it's around 22 million. It's growing at 32% and then around 22%. What's happening with the gross profit margin? So so they are smaller in size and they are 30%, and then they go to around about 26%. And even the EBITDA margin, so EBITDA margin is kind of increasing from 6 to 10%. Even on the EBIT margin, they've seen some improvement here. Then I would also look at what kind of capex they are maintaining, or what kind of capex they have to kind of fuel in that growth. So I see that okay, they have almost 500,000 of capex going in at an average, and then they also have a 500,000 of capex into the terminal year. Okay. Now, based on this, I will be, looking at a couple of things. All right. One, I would be looking into history. I'd be saying that, okay, fine. How has this company really, really grown? Many a times what happens if you're doing a startup valuation, you don't have access to history. But if there's a company which has been operating for the past 5 to 6 years, you still have access to the past information. So you would be looking into their margins, you'll be looking into their growth rates, you'll be looking into their revenue to capex numbers, and you'll be trying to make an assessment, a mental note as to okay, fine, what's happening on this valuation. Then most importantly, I would be looking at this number very closely. Now, this is something that, I will be sitting with the management. Now, mind you, all these numbers that is here, these are numbers which come to me by the management. Generally speaking, just like how an auditor is not allowed to kind of go and make accounting entries, if I receive these forecasts, I would not make any adjustments to these numbers, right? I would recommend the client to say, hey, you know what, I think that this looks a little aggressive. Why don't you kind of take a couple of percentages off your revenue numbers or your EBITDA margin, because that's what I feel is correct. Because not only this is what I feel, I would also give them an industry report, right? I would give them an industry report and say, hey, you know what, the industry report seems to be growing a CAGR at around 8%, but here you are at 12%. What's going on? Now, if they have a reason, fair enough. If they don't, then we will have a discussion around that. What's important is that my terminal year number, okay? So while they are doing whatever they are doing here, my terminal year number and terminal year and the valuation around the terminal year, so that's kind of that's a significant item, or a significant percentage of value comes from the terminal year. So I will be kind of paying a lot of attention on the terminal year. So what's happening here is that I would say, okay, fine, my industry report says that they would be growing at 7% year on year, and that's at 7%, so I'll be fine with it, right? Now, what is 26%? So what do I do if somebody says that terminally, in perpetuity, I'll be growing at 26%, or my EBITDA margin would be 8%? So I would be looking at peer group companies, and I would be looking at their margins, because these will essentially be large companies, and I'll be kind of drawing an inference as to okay, where they are coming from. So I need to make all these mental notes in my mind to then say, okay, fine, whether this looks reasonable or not. Okay, so this is something that I would do. And then based on that, I would say, okay, fine, this is the free cash flows to the firm. And I would say, okay, fine. So now this is my take on the terminal year number. Now let's go to the second item. The terminal value, I think we've kind of taken that. There is a computation of the terminal value. We will actually go about that as well. Then we will see the discount rate, right? So the weighted average cost of capital, as to how do we determine the weighted average cost of capital. Then generally speaking, this is one thing that we do, is that when we are discounting each and every number, we use what we call it as a mid-year convention. So if you look here, we have this 0.5, 1.5, 2.5, 3.5, and 4.5, as opposed to, just having 1, 2, 3, and 4. So that means that when I'm discounting each year's cash flow back to the present value, I would be raising this to the power of zero point 0.5, to the second year's cash flow to the power of 1.5, as opposed to 2. So that means that the cash flows are basically flowing in evenly throughout the year. So that is something that I would definitely do. What else? I will also then be adjusting for non-operating assets and liability, and then obviously I'll be checking overall for the forecast and the value conclusion. All right, now let's go to the let's go to the discounted cash flow model. All right, so here I have my free cash flows to the firm. I have done my mid-year discounting. I have used a present value factor, which is basically my WACC, because this is free cash flows to the firm, and I'm discounted it, and I've gotten these discounted numbers. Now, I would like to draw your attention on this calculation, right? So this is my terminal year cash flow, which is 1373. How did I get this? This is from here. Okay, I have taken my terminal year cash flow, and then I would capitalize this by my capitalization rate, which is nothing but my discount rate minus the long-term growth rate. Now, if you can, this is basically the classical Gordon growth formula. Many a times I have seen valuation wherein they actually take this number and use a market multiple to derive a value, right? And generally speaking, I would not say it's an incorrect way of doing it, but if you would, most of our I would say all of our valuation, we use the Gordon growth method to kind of get to a value. But well, we've seen some appraisers who have been doing multiples directly on the last year cash flows. So the jury is still out on that one, and but if you ask me, we would recommend using the Gordon growth. So this is what is happening, right? So this is my terminal year value. This is what 5188, and aggregate. Okay, I'm getting a valuation, enterprise valuation of 6481. Hold on to this. We have a couple of things which we would like to discuss, because these are questions that have been asked to us by our clients as to the operating cash and so on and so forth. So we will be talking about it in detail. Now, what you see here are all my non-operating asset. So any kind of non-operating asset which is not being used in the business, I will be adding to the value, which is around 239, and then I will be getting to the market value of invested capital. Since we are using the free cash flows to the firm, I am getting the market value of invested capital. But since I want an equity value as a final value conclusion, I will be reducing the debt that is as of the valuation date, and then get to a value of the equity capital. Okay. One thing which was not covered here was the discount rate. Okay, so we will talk about the discount rate in more detail in the next slide, and I will just walk you through. Okay, right. So just like what we said when we are looking at WACC, right? There are those various components of WACC that we look at, and it's a risk-free rate, equity risk premium, beta, then the industry risk premium. So either you use the industry risk premium or the beta, then you use the size risk premium and the company specific risk premium. So I'll just quickly, maybe 2 odd minutes, I'll just quickly walk you over each one of them, just so that, if at all there are any questions, I'll be more than happy to take them. Okay. So as I said, we've always thought of it as a classic relationship between risk versus reward, right? So if you're putting your money in the government bond, you would be, let's say, taking around 6%, because you would believe that the RBI bonds are virtually default free. Okay, so that is something that you would really accept. Would you be okay in investing in a company and having a return of 5%? So the answer is simply no, right? Because you would say, no, I would rather put my money in the RBI government bond and get around about 6%. So that is something, that is one, on an aggregator, you would say that, okay, fine, that this is something that I would definitely want, which is at 6%. So that's added to the discount rate builder. The second thing, you would say that, okay, fine, if I'm investing in a portfolio, in a diversified portfolio, and the market return over and above the risk-free rate is, let's say, 10%. Okay. Now you would mean that 6% plus 10%. So round about, if I'm just adding 6 and 10, so around 16% is something that you would get if you are investing in the market. But there is a beta element to it, right? So if, let's say, if you're investing in a market, and if the beta is, let's say, 1, so you would be okay with 16. But if the beta is, let's say, 2, so you would be getting 20 plus 6, which is 26, right? So you would want to kind of then factor in that risk as well, right? Because that is something that you need to then get rewarded for, because you're taking that additional risk. Many a times what happens, if the beta is something which is not readily available, or you're not computing it, the industry risk premium also gives you a fair proxy for beta. So that is something that you can definitely take for your valuations. And then the size risk premium, which basically means that if you are investing in a company which is smaller than the general market, then you should be getting rewarded for the size risk premium as well. And okay, so now the company specific risk premium is a tool that, generally speaking, you can use when you want to, when you believe that the forecasts are a bit too aggressive, okay, and because of which the valuation is slightly higher. Okay, so what it means that, I'll just take you, okay, this is the classic built up of this is the capital asset pricing model. Okay, so this is a capital asset pricing model, and this is how the discount rate is built. Okay, so there is a risk free rate, there is equity risk premium, there's a beta, then there's a size risk premium, and then there is this company specific risk premium. All of this, the first, second, third, and fourth, are something which you get from market data. Okay, so this is black and white. There's no change that really can happen on this. So when you're putting this sheet up in front of the client, they would say, okay, fine, I hear you, but what is this 4% company specific risk premium? So this is what, generally speaking, it's a tool that's available to you as an appraiser. If the forecasts are too risky, or rather, if you look at this, the factors considered for evaluating the addition of a company specific risk premium include stability of the industry in which the company operates, diversification of product lines, stability of earnings, earnings margin, financial structure, management depth, and achievability of projection. So all of these, okay, you could say that, okay, I believe that that the management depth is not there, you will add a 0.5 percent to it. You believe that the achievability of projections, you have serious doubt on it, you can add a 0.5% for that. You say that, okay, you don't think that you will be having access to capital, and because of which you fear that they will run out of cash to burn, you could add something more to that, right? All of this you would add to your discount rate only if the management is not changing its forecasts. So going in this example, okay, let's say that here you thought that such kind of a growth, or let's just talk about the margin. You thought that this 6% to 10%, this company will not be able to do that. Why? Because you have an industry report that says that that the growth rate for this industry going forward is only 5%, right? Now if that is the case, and the management is still kind of giving you these forecasts, okay, you can very well add a company specific risk premium to adjust for that additional risk, for that alpha. Okay, right, so this was the modified capital asset pricing model. Okay, so this is your cost of equity, you do your cost of debt as well, and then based on this you are doing your weighted average cost of capital. Generally speaking, when you're looking at a cost of debt, what we do is we do a z-score analysis, and based on that we kind of look at what the cost of debt would be based on their credit rating. Many a times the company have themselves been able to borrow, and that could be a good rate. But again, it depends on the purpose of the valuation, right? I mean, if you're doing a financial reporting, valuation is a concept of market participant and so on and so forth, which we will be discussing. But if you're doing it for an income tax purposes, where the standard of value is fair market value, you would still be able to kind of take some of their entity own specific assumptions for the valuation. Okay, this is the next slide, and that talks about the built up of WACC. using the built up method. And now you see here, other than the beta is gone, and in comes the industry risk premium. So this is what happens if you're using a not a modified capital asset pricing model. Okay. I think this we have discussed, but more than this slide, I think the other two slides would really make sense. Just in case if I have not picked up anything out of this, I will. Okay, so I think this is important here, that if you're using a free cash flows to the firm, the first level of value that you get is an enterprise value. Now, if you want to issue an opinion for an equity, you reduce the long-term debt and the preferential capital, if at all there is any, to get to an equity value. If you're using a free cash flows to equity, you would directly get to a free cash. You would directly get to an equity value. So equity value is computed as an aggregate of cash flows. So I think this is something which will be interesting. Okay. Now, if you look at this, this is free cash flows to the firm. So again, if you look at net income, this is your net income. And there has been two additions which has been made, right? One is the depreciation and amortization, which would be the case if you're doing FCFF or FCFE. But what is interesting is that your interest expenses, one minus the tax rate, has been added back. Why? Because the net income here had a charge for the debt. So that you've actually added it back. And then based on that, you've come to an FCFF. And then the discounted free cash flows to the firm is discounted at weighted average cost of capital. And like what you see here, once you get to the firm value, this is a firm value. So this means that this is equity share as well as the debt holders. So you're reducing the debt to get to an equity value. Well, here from net income, like how there was an addition, you've added back interest expense. This is no add back of interest expense. That means that the net income over here has already taken the servicing of the debt in it. So that means that this cash flow, this cash flow 172334 300, so on and so forth, this is available only to the equity shareholders, and that's why that cash flow is discounted at a cost of equity. Okay. I think one more question. There are these questions that keep repeating many times as to what do we do with excess cash. So when we are looking at a valuation, we are trying to get to an enterprise valuation, right? As the first step. From there, you reduce the debt. You reduce the preference share capital, and then you get to an equity value. But when you talk about the enterprise value, so that is basically the valuation of the entity, which is a valuation of the operating entity, right? Many a times entities or businesses have surplus cash, right? That cash might be just lying on the balance sheet, but that may not be the requirement of the business. So when you're doing a valuation and when you're doing your working capital analysis, at that point in time, when you're looking at cash as a working capital, you need to only take the operating level of cash in your working capital computation. And a very good way of doing it is sitting with the management and checking with the management as to how many months of cash do you need for your operating expenses. And generally speaking, it would be 1 to 2 months of cash. Okay. In times like these, probably they might want to hold on more cash, right? But again, generally speaking, it's 1 or 2 months of cash is typically what the enterprise would like to hold. So what you do is the next 12 months of forecasted expense divided by 12 is your 1 month's cash. So that is the amount of cash that you should take in the working capital computation. The residual cash you should add over here, okay, as non-operating asset. Okay, I don't see here. Okay, nonetheless, but if there was, so if in my example, if there was a cash which was not really accounted for in my increase this investment and release of or investment in working capital, I would only take my 1 month's cash. The excess cash I would essentially add here, and then that will be added to the value as a non-operating asset. Okay, so this is something that we kind of get a lot of questions, from our clients. Okay. Right. Also, there are these surplus assets, right? And these assets could be, having some kind of an income. Uh, and since you are valuing the business as an operating entity, any of those assets which are not really core to the business, those income should not be really added into your discounted cash flow model, because that really, just puts your whole comparability in a complete disarray. So you only want to have returns of the business asset on your discounted cash flows, and anything which is a surplus asset, you may be better off in considering it separately. Okay. Okay. Many a times what happens is that, and this happens with us because, there could be, let's say, a Netherlands structure or a Singapore structure, which is a holdco. And then there are a lot of other entities, which are the operating entity, right? And if you want to, let's say, value the holdco along with this. So generally speaking, I've seen that dividend income as if, that once this will be liquidated and this will be essentially repatriated, and, there will be that. So let's not never I would not say that that's something that one should really do. You could very well you could very well value those specific jurisdictions separately and then add the value to the holdco. Or you could ask the business, the controller and the CFO to basically give you a consolidated cash flow of, let's say, if they are operating in 6 geographies, to give you a consolidated cash flow, have choose a currency in which you want to value. Generally speaking, it's the US dollars. And then based on that, you do a valuation, right? So I would say that even if there are, I've seen a couple of, valuations being put in the court as well, wherein there are, these but pretty old valuation. But, I think the better way of doing it is that take the aggregate cash flow and then make a valuation at the aggregate level, or use those individual value those individual assets, subsidiaries, and then basically aggregate it. Aswad Damodaran has a fantastic paper on this. I think it's called Valuation of an Octopus or something like that. If you can just search, that's a fantastic paper when, you as practitioners are coming across, valuation for companies which are operating in multi-jurisdiction, multi-locational businesses, and how do you basically go about valuing that. Okay. This is also so many a times what happens is that if there are some tax losses, right, past losses which can be used against your future profit. Now if that is the case, never take those directly into your DCF, right? Have a separate computation, because what happens is that if these past benefits, the losses gets into the computation of your terminal value, that will completely put your valuation in a disarray. So have it separately computed and then add the value of the tax benefit as a separate line item. As you could, just like how we did a non-operating asset add, you can actually take the present value of the tax benefit and directly add to the value. Okay. Uh, let's now talk about the market approach. Okay. So when we started this discussion, we did say that that there is a discounted cash flow model and then there's a capitalized cash flow model. If you know what the discounted cash flow model is, the terminal year, which we saw it as a terminal year, you could very well think of a capitalized cash flow model is that 1 year of forecast which the management has given, and you, based on that, you derive your own assumption as to what the future would be like, and then based on that you would directly doing a valuation. I don't have a slide for that, but I'll tell you exactly what that means. I'm sorry, when I've just quickly go back on this. Okay, so what you see here, okay, this valuation what you get here, so let's say that you would have a terminal year, so basically this would be your valuation, right? So that means that you do not have anything here. You just have a 1 year earnings, which is, let's say, this. You normalize that and you said that this is my normalized cash flow going forward, and then this is what you capitalize, right? So that is capitalized cash flow. Okay, so that is the only difference. And again, if the company, like I said, the life cycle in which the company is currently operating in, it's almost at the mature stage. So let's say if this year they are like around about 7%. So you don't have to do much, right? Because you would say, okay, my terminal year is 7%, and that's how I will be going about and valuing my company. Let's now go on to the market approach. Okay. Right. So, as the name suggests, okay. And before I go on to the market approach, I would say that most of the even if there are companies which are, just starting business, right? If you sit down with the promoters, understand from them their business model, so discounted cash flow might be the only method that you can employ for companies which have, which have not started making money, because your EBITDA multiple, one of the multiple that you can take is an EBITDA multiple when you're doing valuation as per the market approach. It will be a negative. Some companies might not even have revenues, right? So really speaking, the market multiple at that point in time will not be useful. So you may want to kind of, know your discounted cash flow model, because again, you sit down with the promoter, hear their story, that, probably 1 year down the line, we'll have our first client, 2 years down the line will be cash positive, and 3 years or 4 years down the line will be, net income positive. So that's the story that you need to kind of hear, and then that story needs to translate on your spreadsheet, your model. Okay, let's now quickly go over the market approach. Now, just as the name suggests, there. So think of it as, now you are a company in a particular space, and you have companies which are similar to you. I would not say identical, but which are similar to you, and which are trading companies, right? They're trading on any of the stock market, on the stock exchange. Now they will be having the trading prices, right? Based on those trading prices. So let's say that I would say, okay, fine, that there are these companies which are trading on the national stock exchange, and based on that, I can see that they have a revenue multiple of X or an EBITDA multiple of Y, right? I will be taking that multiple and applying it to my revenue or to my EBITDA to get to a value. So that's what's happening on the market approach. Now, how do we go about doing it? That's what we will be discussing quickly. So that's the one which I just mentioned, was the guideline public company method. The other method is the guideline transaction method, right? It means that there has been some transactions in your space. Okay, so let's say you're into a semiconductor space, for example, and there has been some transactions which has happened in the semiconductor space, and that transaction is at, let's say, X multiple of revenue or Y multiple of EBITDA. Now that is also a price that you can actually apply to your revenue, your EBITDA, to get to a valuation. Now that is the guideline transaction method, right? Again, let me draw your attention to what it says is that transaction multiple derive from the sale of companies that are similar to the subject company, and the guideline public company method means that trading multiple derive from publicly traded companies that are again similar. Okay, so it's not identical. We call it as a pure play comparable. Okay, many a times what companies, the business that they operate, it will be very, very rare to find a company which is an exact comparable. Okay, so generally speaking, we'll say that it's similar and we can derive value from there. Excuse me. Okay, the multiples that we generally use, when I started practice, we used to use a price earning multiple as well. Generally speaking, nowadays it's more of the EV to revenue, EV to EBITDA multiple. Many a times it could be, on pharmaceutical, it could be R&D and so on and so forth. But these are the typical multiples that we use for valuing companies on the market approach. Okay, just like what I mentioned is that when you're looking at companies, what we do is we try to put a rejection matrix going for us. So which means that we will be going into the annual reports, we'll be going to the filings of companies which we believe is peer group, and we will be looking at all of these characteristics into that. So whether they are in the same industry, what kind of size of those companies are, when we are looking at their listing on the market, whether they are being actively traded, whether I can really use that price to basically value my subject company, what kind of information is available, the trends, profitability, growth, and the ratio comparison. So that this is something that I will be doing with my subject company to kind of get to a value. Now, there are some adjustments that you can do, which we will talk about when I'm just going over an example of this. But I would say that, it's very intuitive. So it's like, you have to just find a company which is almost similar to you, and then try to get into their multiples and use that for us, right? That's what the market approach is trying to do. Okay. Now this is how I benchmark companies. All right. So now here was an aluminum manufacturing company, and I've looked at all these companies. I have looked at into their business description, and I've started making my notes. And I would say, okay, fine. Out of this, there would be, I would have, let's say, 25 companies, of which I have used these 5 companies on the basis of which now I will try to value my company. Okay. So this is what I'm trying to do here. Okay, now this is my typical worksheet which I'm using. So what you can see here is that I'm using my EV to revenue multiple. I'm using EV to EBITDA. So these are my trailing multiple. That means that I'm trailing in the sense the historical numbers. So these are the historical numbers that I see here. And this is my 1 year forward multiple based on analysts who might be covering these 5 companies, right? So I'm getting a good mix of 4 multiples here that I can work with. I'm using trailing multiple, EV revenue, EV EBITDA, and I'm using forward multiple, EV revenue and EV EBITDA. Okay. So, and as you can see that I have tried to, get a interquartile range here. And I'm using the 50th percentile. Okay, so this is the selected multiple. So I've used the 2.2, which I've brought down 15.4, and so on and so forth. My revenue and EBITDA, my revenue of this company is 4.5 million, and this is EBITDA is around 0.96, right? And my forward revenue is 8.2. Now, based on the multiple that I derive here, I am applying this multiple and getting to an enterprise value of 10 million, 14 million, so on and so forth, right? So this is how I'm getting to the enterprise value. Like I said, you will be adding cash and cash equivalents. Then you get your market value of invested capital. You apply the weights, and then you get to your weighted market value of invested capital. You reduce your debt, you get to the value of the minority marketable value. Why it's minority marketable, we will be talking about that as well. Excuse me. We will be talking about why it's a minority marketable value, and then we'll be applying a discount for lack of marketability to get to a value which we call as the minority non-marketable value. Okay, now this is important. While I'm not get into too much technical, but just if you can just look at this setup, it will really help when we're looking at what the level of value is, because we do get questions as to what is a control value, what is a minority value, whether we should be applying a discount for lack of control or discount for lack of marketability, so on and so forth. So we will look at that as well. Just like how we had the guideline public company method, there is the guideline transaction method. So there are these transactions which have happened in this space, and based on that we are deriving a value. Okay. Many a times we get this question on valuation of early stage companies and startup. And to be really honest, these are more of pricing methods, right? I mean, this is how you price them, because at various stage, a non-revenue making company generates revenue. There is a difference in this valuation. Not making profits, now they are making profits, again there is a difference in the valuation. But for most of the valuations, if you are using the discounted cash flow, so there could be a separate session which we can take. We can just talk about the startup valuation space. But this is something which we have been using for all our valuations when we are using the discounted cash flow method for early stage companies. Okay, and this is a great tool, and you can also be using this tool for valuing companies which are in the early stage. So this is what we do, right? uh, we just simply look at whether there is a management team, business plan, financing history, all of this, and we just put our tick mark against this. So let's say if there is this company which has approached us for a valuation and they have all of this, right? I would say that they would be in a range of around about 25% to 35%. Okay, so this is where you can actually start with, and then talk to the management and try to understand, okay, why it should be something different. Okay, but this is something which can definitely be used as a tool, and I thought it might be handy to all the participants. You would see this in a couple of our reports that we issue for companies in this stage. Okay. Now a quick, take on, what kind of data requirement, right? And I think while we can have a long list, okay, of specifics that we want to ask our client, but I think more or less this is something that you should definitely have, you know, uh, 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 ask your client as to, that this is something that you had. And the most important thing is whatever they send you, right? Projected revenue, profitability ratio, rationale for the above information is very important. So if they are growing at X, Y, and Z, a narrative as to why they believe that they are growing at X, Y, and Z. So this is something which I believe is very important. And so is the marketing brochure, which is basically the go-to market strategy as to how do they, today if they are at X market share, how do they intend to go to X plus plus plus, right? So this is something which I would say is very important. Also, let's not lose focus that we also need the balance sheet as of the valuation date, because that is the thing on the basis of which you will be making the adjustments, whether it's a non-operating asset, liability, your working capital, your cash, which you say it as non-operating. So this is something which you definitely want to have on file. So that is something which is definitely important. Okay. Now, quickly, I will go over the levels of value, because this was again, this has been something which has been, a lot of questions have been asked. So there is, if you're doing an income approach valuation, if you're using a discounted cash flow method valuation, so what kind of value you get? Okay, so it depends upon the forecast, right? So let's say if today you're dealing directly with the promoter, and that promoter's thought process is into that financial model that you've gotten. These are board approved models, right? So the discounted cash flow model can be a control value, or it could be a minority marketable value. So what that means, many a times when you are valuing a company, okay, and so now this is a classic case, right? So we value a company which or we value this company which holds around 15% stake in this larger company, right? But they are like a portfolio company. They have various levels of investment. Whenever they get information from the company, they only get what they are made to see, right? So at that point in time, the cash flow that is available to my client who is holding at 15% he may not necessarily have the vision that that company's promoter probably has for the investment company, correct? But if you're dealing with a promoter who's essentially owning the entire business, then they would say, okay, fine, this is what I feel that this is what the revenue growth would be, X, Y, and Z. So whenever there are these, so who is giving you that information? Or for that matter, even, you might be doing a valuation based on an analyst's number. So even that analyst will only get information based on analyst call, right? So at that point in time, you may very well say that, okay, this may not necessarily be a control value. It might be a minority marketable value. There are the levels of value. We'll be quickly just going over it so that it all kind of, fits in. But this is important because whenever we are doing valuations in India, and when we are looking at the levels of value, we need to understand that what is my preliminary source of information, and whether the valuation that I'm getting is my control value or a non-control value, right? For ESOPs, if you're doing valuation for ESOP, generally speaking, it's a minority value, because the ESOP, at the most, it might be 3 to 4% of the stock pool. So so the valuation at that point in time is a minority value. Okay, now let's look at this. So the minority marketable value, look at it as the valuation that you get from the stock market of your peer group companies. Okay, so you are a subject company A, and you are valuing this company based on the guideline public company method, and based on that you are getting to a value. So those are values which are derived from the stock market, which are basically between the minority holders, because most of the transaction of stock market is between minority holders. So any value that you derive using your peer group companies from the guideline public company method is the minority marketable value. That's what it tries to say here. Market approach guideline public company method is a minority marketable value. Okay. Now, if you are sitting with your client, discounted cash flow is what is being given to you, which is board approved, management approved, 5-year forecast. That is a control value. Okay. So if you are if you're using your discounted cash flow and you want to value for an ESOP, so you will have to first apply a discount for lack of control, and then you will have to apply a discount for lack of marketability, because you want a minority non-marketable value. So if you're using a DCF, a discounted cash flow, and your use is ESOP, you will be applying two kind of discount for lack of control and discount for lack of marketability. That is if you're using the discounted cash flow method. If you're using a guideline public company method, you will be using one level of discount, that is a discount for lack of marketability, because the value that you need is a minority non-marketable value. Okay. So this is something which, and as and when you see this, you would kind of know as to, what we are actually trying to get at. And then based on that, you would be applying that kind of control or a discount for lack of market. Let's say you're doing an impairment testing. Okay. Let's say that you're doing an impairment testing, and one method that you use is a discounted cash flow model that is a control value. Will you do any kind of discount for lack of control or discount for lack of marketability? No, because for impairment testing, you need a control value. Okay, so for a discounted cash flow model, which gives you a control value, you will not put any kind of discount or premium. This is what you want. But when you are using a guideline public company method, the level of value that you have gotten is a minority marketable value. Then you will be adding a control premium, so that even your GPCM, the guideline public company method, gets you to a control value. Okay, so I will um, okay. And if you look at it, here we had the minority marketable basis, and the only discount that we applied here was the discount for lack of marketability, because we wanted the minority non-marketable. So this was the guideline public company method. Now, if you go to look at the guideline transaction method, so these were all transactions, 100% transactions. So you've applied two kind of discount. You have applied a discount for lack of control, and you've applied a discount for lack of marketability. Okay. So just be aware of, what level of value you are requiring, and then based on that, where you are, what method you're using, and then what kind of value that you need. Again, we just kind of touching this, there is a lot of things that can be discussed when you're looking at control premium, when you're discussing discount for lack of marketability. There's a whole put option, study which can be done. So that is something that we have discussed with Daya and Pankaj. So probably if there is a need to even have those kind of discussions, we can definitely have those as well. Okay. Uh, I I think we also have to have a 15-minute Q&A. So I would go over some of these. So this is just a listing of the financial reporting valuation standard, which is as per Ind AS and IFRS. And if you look at it, most of the standards now are requiring you to do financial reporting, valuations, or basically the fair value. Okay. So I think a lot of these inputs will definitely be useful when you're looking at financial reporting valuation. Okay. Just a couple of concepts which is little different from, when you're doing valuation for a deal or for income tax purposes, because now Ind AS is something which is new, and a lot of my friends who are actually practicing chartered accountants have really asked as to about the market participant, the highest and best use, and so on and so forth, and how a simple usage of the term market participant means a lot of value difference between your valuation for income tax purposes versus your valuation for financial reporting valuation. Okay, so it is possible that, let's say if today you're doing a valuation 31st of March 2020, you're doing a valuation for income tax purposes. Okay. And at the same date, you're also doing a valuation, let's say for an goodwill impairment testing. It can very well happen that the two valuations will be different. Why? Because the standard of value that you use while doing valuation for income tax is generally the fair market value, and the standard of value that you use when you're doing valuations for financial reporting purposes is fair value. Okay. And the definition of fair value is that price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So this market participant, this these two words means that a lot of your assumptions will differ when you're looking at valuations for financial reporting. So that means that even if you are having a favorable finance position, okay, your debt equity ratio is, let's say, 80/20, but an industry debt equity ratio is 50/50, you will not be able to take advantage of that favorable debt equity ratio and do the valuation, especially when you're doing a valuation for an impairment purpose, because you would have to then rely on the market participant assumption. Okay. so so that's what the market participant assumption is. There are a lot of things we can talk about, the orderly transaction and so on and so forth, but let's just focus on what the market participant assumption is. So quickly, when we are talking about market participant, we are talking about market participant in the sense they have to be independent. Okay. The transactions cannot be between two related parties. uh, they have to act on their own economic interest. That means that they have to be a principal and they cannot be acting as an agent. They have to be sufficiently informed and they should be knowledgeable, so that the price or the transaction, because let's say there are 10 market participants, all the 10 market participants to be used as a set of market participant pool have to have these qualities. So they have to be independent, they have to act on their own economic interest, they should be knowledgeable about what they are trying to let's say pitch for. They also have to have an intention and an ability to transact. Okay. It's not that that they did not have an intent to transact, and even if they had an intent to transact but they did not have the means to do that particular transaction, but they are still putting a price. So that means that that will not be categorized as a market participant. So these are the things that when you're looking at your peer group and so on and so forth, when you're looking at industry ratio, you would be wanting to look at the market participant assumptions, and you would be looking at it based on these five parameters. Okay. Also, the concept of highest and best use. So this means that many a times what happens is that if there is a M&A happening, what happens is that um, you know a bigger brand buying a smaller brand, and the bigger brand says that, okay, fine, I'll probably not be using this brand for more than a year. Okay. But that still means that highest and best use means that if this smaller brand has a wherewithal to to generate revenues for the next 5 to 10 years, when you are doing a valuation, you would have to take the forecast for 5 to 10 years. It's not that just because the entity himself wants to use it only for a year, so they would take a forecast only for a year. So what that means is that you would be valuing it based on a 10-year life. But if the entity wants to write it off only in a year, they can very well do it. But that should not restrict the value to only 1 year. So the value would be as if it's for 10 years. But now if the entity says, okay, fine, post acquisition and probably writing it off in a year, you basically book it in P&L. Okay, so these are some things which is very important when you're doing a M&A, and if you're doing a purchase or allocation. So these are some of the concepts that you may want to kind of be aware as to how this will really have a repercussion on your post combination balance sheet or P&L. So once the transaction is done, what kind of repercussion that can have on your income statement post M&A. Okay, now this is something also which we kind of keep on hearing, and that is the hierarchy. So always remember, when you're doing a financial reporting valuation, your quoted prices has the highest weightage, Okay, so that is something which will always be at the top level hierarchy. Your discounted cash flow method might be at level 3, and everything else would be in middle. So even if you're doing a valuation as per the guideline public company method, wherein you are using a valuation model based on observable inputs, or observable trading price on the market or of transactions, that will still not be a level 1. Okay, that will still be a level 2 input. But discounted cash flows, generally speaking, which it says reporting entities own data, it's basically more or less we'll talk about as a level 3 input. Okay. um, so a quick take on the intangible valuations. This has been something which has been very close to us. We do a lot of valuations, which is financial reporting valuation, and when we're doing financial reporting valuation for cross-border M&A or even domestic mergers and acquisition, setting up the opening date balance sheet and recognizing the intangible has been something which has been always very close to us when we are doing the deals. And I think that this is more of a you can use it as a practical checklist. What we are having in a couple of other slides, you can really use this for each one of your engagements. Okay, now the intangible valuations which we generally, so what are the purposes for which an intangible really needs valuation, right? One is obviously the financial reporting valuation. It's also needed for the taxation support. So let's say for transfer pricing, if you are having an intangible in X jurisdiction, you want to transfer it to Singapore or Netherlands or Switzerland. So that is something that will be requiring an intangible valuation. Estate or gift planning is something that will require intangible valuation. Many a times, the classic case of Kingfisher, everybody knows about that. But if you have an intangible on the basis of which you basically want to get loan, that is also, you could do an intangible valuation for that. um, Determination of fair for the purchase of sale, yes. And many a times what happens is that there could be just this brand name or an R&D asset which may really not meet the recognition criteria, but there could be something which should be transferred between two entities that also then is the subject matter of that. Many a times when there's a dispute between the family or an infringement of a particular intangible, that really requires an intangible valuation, so that you can determine the amount of damage that needs to be kind of paid. Singapore is one jurisdiction which actually has a lot of arbitration cases which goes in over there, and more often than not, it's generally the arbitration which is for such disputes, are the subject matter of it is intangibles. Okay. This is still more of accounting, so I'll I think I don't, how are we doing on terms of the time? Daya and Pankaj, are we good, or I think we
Yeah, it's going on well, Rajesh bhai. Continue, because it's very, frankly, I'm telling you, very great going. So continue it. It
Sure.
shouldn't be a problem.
Sure. Thank you. Okay. Right. Just give me a minute. I'm just putting it on the right side. Okay. Yeah. So when we talk about intangible, so let me give you a context here, right? So A company is buying B company, right? And now with Ind AS, um, the intangible that needs to be recorded in the consolidated books of A post the acquisition of B, okay, you would look at customer relationships, trade name. So let's say A bought B, and the main asset was, let's say, customer relationship, right? There was also this fantastic trade name that was available, and that was one of the reason that they basically made that acquisition. There were some fantastic technology that was being developed. Okay, so what it means today when we are looking at the Ind AS framework, that means that all of your thought process for acquiring that particular entity will be in a way reflected on the opening date balance sheet as one of the intangibles. So A, when it looked at B, it said, okay, fantastic, this customer relationship that it has, we really see a lot of value in that will be valued and it will be brought to the balance sheet. This trade name that it was using, Okay, a things that okay they can make a lot of use of that particular trade name. When Dabur acquired Femcare Pharma, they used to have that skin whitening lightening bleach, right? The Fem bleach. They continued to, even till today, the Oxy bleach, I think, and the Fem, they continued to use that name. I don't know whether they're still using it now, but they continued to use that name for almost a 10 odd years. Okay. Coca-Cola, when acquired Thumbs Up, they still continue to use the trade name, Thumbs Up and we still get Thumbs Up, right? So all of those acquisitions, when the crux or the idea, the ideation behind that, those acquisitions will be on your balance sheet. And this is how you would say that, okay, if there is an intangible which is contractual or which is separable, then it will require a separate recognition as per the Ind AS. Okay. Now, if there are intangibles which do not meet either the contractual criteria or the separable criteria, then it will be part of the goodwill. Okay, then there will not be a separate recognition of that intangible. So that's what basically the standard says. And assembled workforce. So there is this question, right? Assembled workforce is one intangible which probably might be the most important intangible that anybody will acquire, right? Because the people, but it does not meet the criteria of contract. It does not meet the separable criteria, neither the contractual criteria, because while you can have a contract with one or two people, but if let's say 100, you cannot have a collective contract that all these 100 will be transferable to us. That's not the case. So that's why, as per the gap, while it is an intangible, okay, I would say that workforce is intangible, but gap doesn't require or does not allow you to recognize that as an intangible asset. Okay, so this is just a graphical representation. You can actually use this as a tool. Whether this any asset of yours on your transaction is can be recognized as an intangible or not. But this is a fantastic list, I would say. And whenever you're doing any kind of M&A work, and if any of your clients are or clients target are having any kind of these intangibles, you could very well see that, okay, whether they're meeting the contractual criteria or the separability criteria, and whether if they meet this criteria, that means that you should have a discussion with the management to basically value those particular intangibles. So that's a 2-pager list, and I think it will be really helpful. Okay, a lot of these methods, and we will not be kind of going in depth in these, but if you look at the income approach and the multi-period excess earning method, this is something that you use to value your primary intangible. So let's say in the example I said, customer relationship was a primary intangible that was acquired. You would be using the multi-period excess earning method to basically value the customer related intangible. If let's say trade name or a brand name is your primary intangible, then you will use a multi-period excess earning method to basically value the primary intangible. We can have a separate session if at all there is a need for looking into intangibles and the valuation methodology of intangible. We can definitely have a separate session. um, like what I said, when you are doing a business valuation, the cost approach, generally speaking, is not used. Okay, I would say generally speaking, it's not used. 95% of the time, we'll be using a market approach and a income approach. 5% we will be using the cost approach when we are doing a valuation for business. But when we are doing a valuation for an intangible, I would say that the market approach is generally not used. Okay, it's very, very difficult to find a similar intangible like yours, and even if you find it, you will not be able to get traded prices for it. Okay, market multiples for it. So cost approach is something that is used. Okay, and the income approach. And if you look at the multi-period excess earning method, it's a derivative of the discounted cash flow model. Okay, so this is how the intangible valuation is really looked at. Okay. um Many a times, we've when we are putting a report together, and again, depending upon who your RV registered valuer organization is, they would be coming out with their with their reporting framework, the structure. But I would say that ensure that when you are putting a report out there, that report should be a speaking report. Okay, and Daya, when he started this discussion, he did mention as to there are reports which at times 50,000 or a lakh of rupees. So I would say that uh, the requirement of producing a report based on what even now the ICAI standard is a pretty onerous requirement. The kind of research that needs to go in, your industry reports, your economic reports, the market analysis, the SWOT analysis, just giving a lot of detail on the historical numbers, doing ratio analysis, doing comps, the database cost that one has to incur if you are actually having to get a good quality report out there. So those costs really add to your cost of delivery, right? And you want to have a report which will stand the test of time, because then there has to be a documentation across behind that report. So you want to ensure that whatever you sign today, 2 years 3 years down the line, you have a basis for it. And all of that really requires time and effort and energy. And I would say that while this is not like the be all and this kind of says everything, but this is just a flavor of what should definitely be on your report. You ensure that if you are having your discounted cash flow model, your market approaches, you have to have the necessary exhibits, appendices on the report, so that it's a talking report. Okay, not it should, I've seen that many reports will be 10 pager, and first page will be a transmittal letter, then there will be some disclaimers for another 4 pages, and then there will be a little bit of description on the company, and then last will be the valuation conclusion, without a discussion on okay, why you've used a discount, why you've used a terminal growth rate of 5%, why you've used a dollar denominated discount rate. All of that is not there. So what I would say is that um, look at what the requirement of the institute is, and I think that some of the things that they have put down over there is fantastic, and those are really good quality things that a good quality list, I would say, for you to kind of look at and then do a valuation on. Okay, now this has been something which has been discussed. We actually did a whole webinar on this topic with Tax Sutra. And I would definitely like to kind of share my learnings on this, uh, and Daya and the others. I mean, I would like to hear if at all you have any other views on this one. So I was in the US. I came back on 3rd of March. Okay. And as you know, at that point in time, there was not much discussion which was happening on the COVID in the United States, at least, right? I came here on the 4th of March, and I know, I think 14th or 15th is when the lockdown nationally was declared here. Uh, when it came to COVID, we were doing a pretty large engagement, two pretty large engagement. One was for a December year-end reporting for a US filer, and the other one was for an India company which is having a subsidiary, large subsidiary in the United States, India listed company, but they were issuing their financial statements as of 31st of March, right? We did our preliminary analysis for one of the big four auditors in February. Okay. And that point in time, so this was an impairment testing, and that point in time, their value conclusion based on the guideline public company method was way above the the carrying value. So they were passing the impairment testing. There was no need for impairment. The whole market in March, the US market, if you look at it, the whole market basically was in a complete state of disarray. We did our valuation as of 31st of March, and 20% reduction in the value conclusion from what we did in in February. So what changed? Basically nothing changed, right? Fundamentally the business is the same, but because of this event, because of this uncertainty, right, the market multiples fell to such lows, and now we are grappling as to what do we do. Correct? Because as valuer, right, if you ask me, I know for sure that whatever happens to the business, right, 6 months, 1 year, most of the businesses will basically go back to normal. Yes, there are businesses, my friend, they've run a restaurant chain, they've just announced that they are going out of business yesterday. Some of the businesses might have shut shop, never to have reopened, right? But most of the larger businesses, right, who are into multi-locational, multinational businesses, and when you look at the risks around this particular event, how do you basically price, or whether you should price the the risk into this, into your valuation, right? And there were a lot of thought process on this as to, what do we do with this COVID situation, what do we do for your impairment testing. And the thought process has been, and this is the consensus that we've been having, at least with my group of people with whom we interact. And let me just break it down quickly. Okay, let me talk about the market approach first, and then I'll talk about the income approach. Okay, so the market approach, in my example, when we did an initial analysis of the market approach, which was in February, they were having a valuation, as I said, almost 20% more than what the valuation was when we did it in March. What we spoke to the auditors, and they actually saw good reason, and they agreed with that, and we said that let's not take the market multiple as of 31st of March, but because 31st of March was the most volatile period. Okay. So we said, let's just take an average market multiple for the month of March. And that's what we did. Okay. So that the impact of, let's say, 31st March market is in a way, spread across the whole month. Okay. So while we were not down, but while the company was not down by 20%, but it was down by around about 5 to 8%. I don't really remember, but I think it was around about 5 to 8% from the February valuation, because we did an average. Okay. So that is what we did on the market approach. Okay. Second, on the discounted cash flow. Okay, we did a scenario analysis. That means that the company, when it made its first set of forecast, it said that this is my forecast. Now, because of this COVID, they made two more scenario analysis. They said everything returning to normal in 6 months, everything returning to normal in 12 months. And now based on that, they gave us two more scenarios. And based on these three scenarios, one is a base case, 6 month and 12 month, we again did one valuation, taking the probabilities of one third, one third, one third, and then based on that we basically did a valuation. So this is something that we did. But if you ask us, as sitting on 31st of March, there is also a concept of known and knowable as of the valuation date. So each one of you all, when you're doing practicing valuation, if let's say you're today signing a report, and let's say today is, let's say, March 31st 2020, you cannot be looking at, and you're signing this report, let's say on 1st of May, you will have to disregard whatever happened from 1st of April to 1st of May, because the concept of known and knowable as of the valuation date precludes you to look at information that is coming to the fore after your valuation date. So your valuation date is very critical. Okay. So and this was March. Now we are looking at the S&P, they are actually at an all-time highs, right? So this was only for that particular period which happened. And so this is what we did for COVID. And I would say that for all the businesses, for all the clients asking you questions as to what we supposed to do, I think we have to probably keep it simple. We have to understand that yes, this phase, probably for a first year, your forecast will definitely have a huge impact. Okay. Second, third, fourth year onwards, okay, I hope, right, that we sooner or than later we actually have a cure or a vaccine or a or a medicine But I would say at the most 1 year, at sitting today, we would say that 1 year is a good time frame for us to understand what's happening, you know, in future. So I think 1 year, if your client is able to give you 3 4 assumptions as to, okay, this is what is happening, I think you may want to kind of work with that. Okay, so this is what we've done. There could be some other thought process as well. You know, we did this, and the same learnings which we had with this big four. So these are the signers in India. They are the group auditor. The big four is a group auditor in India, and also one of the big four is a auditor in the US. You know, so they've accepted this stance, and the same, then this learning from this we kind of used for our other clients as well. But this has been the learning on the COVID situation. Unless you know, anybody here has a different learning, I think I have. Okay, I think this was this was what it was. Daya, I would let you take over if you have any inputs on this one, though.
Yeah.
What to say after you speaking, Rajesh? I think I was sitting and listening to the entire discussion, and you made it so clear and I think understandable. And as we discussed, it was basically the first level of valuation class, I can say, which we started with. And I think going forward, one good thing which we can do, Rajesh, if you can help us out, I think it will be the biggest contribution to the profession is basically drafting of reports on valuation. If you can take a special session on that particular thing, it will be of a great help. Yeah, though I know that we are asking for a trick of trade from you, but I think you know, certain fundamental you know formats, if you can give, I think that will be the biggest contribution, right? As you rightly said, the kind of report writing which has been done and the kind of questioning which is happening, the context is completely lost. Only the content is there in the report. So that is actually making a big problem for the quality of reporting, and undoubtedly it is impacting the professional. You know, it is challenging the professional capabilities of chartered accountants. And when you look at, we do not have any kind of you know, books or any, you know, theories or anything written on how the report writing is to be done. I think if we are able to do this thing, it'll you know, really add value to our professionals in a very 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 effective way. And undoubtedly, I think the way you talked about the restaurant business which is closing down, honestly the biggest fear is where is it we are going to head towards. And the kind of report, you know, the pain is like, you know, honestly I'll tell you, there's a doctor who has a pain in different style. As a chartered accountant, we have a different pain in a different style. When we are signing a financial statement, March would have not been a major pain, but trust me, April, May and June, when you are going to sign the first quarter, it's going to be a terrible thing. I don't know what kind of numbers are going to be reported in the financial statements, and the kind of you know, agony which we are going through. I think this is something which is actually going to change the way we do business. You know, whether it is a traditional form of business or whether it's going to be a new form of business, it's going to be something very different, and you know, which we can't even imagine as a common man. But I think all of us have to sit down for a while and reevaluate where our business is going to be. Might be we had a fantastic valuation before 23rd of March, but I think post 23rd March, what the valuation has been, and is it a time where we need to exit the business, or we need to revamp the business, or we need to redesign the business? There are certain things which we need to really evaluate so that the valuations can come back again. Today, when we see schooling or might be hospitals, the valuation can go up. But again, there is a human value which is going to come into a big way. Corporate, you know, uh, this is a new standard which has come out. I'm not able to. This thing which is there, where you are going to actually evaluate the entire environment which is going to be impacting on these all things. And particularly, just imagine we read in our school day, in early days of CA, about the human value system. We have to do the human valuations. And today, the kind of insurance business which is going to go in a different form altogether, because insurance business in India was only not more than 20-23% of the entire population size, and the kind of carelessness which was being noted. So if you see, there is a different kind of impacts which are going to come, and all the businesses are going to take up a different shape altogether. Even you talk about the chartered accountancy course, what we were and what we are going to be, it is going to be huge amount of difference. So I think this valuation game is something which we need to, when you play golf, primarily, it is an art of life which you do in the entire game of golf. Basically, when you get into the sand, when you get into the water, when you get into the deep sand dunes, and then you need to pull out your life. That is the kind of situation where we are going in. I think this session which you have given, it gives a different perspective with regards to, not different, but I think a structured perspective, I'll put it that way. How things are actually reported in different laws and different requirements. It's fantastic. I think congratulations, Pankaj Bhai. I think we made it again by getting Rajesh Bhai in. We saved our face very effectively, and this is just a beginning. I think once Rajesh agrees to come and give us a session on drafting of reports, I think that will be the biggest game changer for all of us. There is no such session which has happened, Rajesh. One assurance which we can do is we'll make it a huge success before you walk in. I think 1,000 people should be sitting on the screen. That is a target which we'll keep. That will make a whole lot of difference. So this is just a start, and going forward, it will be a different ball game. And yes, friends, one particular request, honestly, don't sign valuation report just like that. It is going to get into a different zone altogether. You have passed, but again, one suggestion is don't underprice, but reprice. That's the only thing which I can tell you all. Thank you very much, Rajesh Bhai, for
I
coming in and giving.
sure there. Thank you so much. We have some questions.
Yeah,
Do we answer them? I mean, how do we do this?
I think, Machara, if you can just take up the questions and at least what you feel, because you know about it, and it will give some time to Rajesh Bhai. You can just read out the questions which you feel are important, and
Okay.
rest of the questions we can just share it with Rajesh Bhai. Whenever he has time, we can just ask someone to reply. And
Right.
You
Must
be screen sharing Roklo, Rajesh Bhai. I think then you can we can see you all.
Rajesh ji, before going to questions, most of the questions regarding some suggestions or advices regarding any scanners or tools for small and medium practitioners, particularly to the valuation. Any something scanners or tools which can be used in a valuation.
So there are a couple of report writing software. I don't know whether there are anything in India, but when we started our practice, this was, I mean, so when I started the valuation practice, that was in 2007. That time there were a couple of software providers, but what happens is that it's a good start because it kind of gets the whole framework together. So that's a good start, but once you take that output from there onto Word, it is better that you make your own edits. In terms of the database, so we use S&P Capital IQ, and we also use Icon, which is Thomson Reuters product. But Yahoo Finance, when I remember when we started off, so Yahoo Finance was a very good source. But because now we are having access to S&P Capital IQ, so we are essentially using that. But I think in terms of the database, I
Yes.
think Provis is something which is used by my transfer pricing wing.
Okay.
We are not using Provis because we are getting most of it from the S&P Capital IQ. But on an India standpoint, let me just get back to you as to if there are some tools available as
Okay.
such.
Yeah. Second one, sir, most of the things on the documentation part, recently the code also has been revised and a lot of stringent provisions in the code of ethics from the chartered accountant's point of view. And can you throw a light a little bit on the documentation part, particularly regarding the valuation?
Right. So, so there are a couple of things. What we do quickly is that, we try to make our report a very talking document. Okay, so most of the documentation requirement in terms of why you use X%, why not Y%, everything is there in the report itself. Okay,
Okay.
but in terms of what documentation we get from our client, and the retention of those documents, we try to ensure that we are kind of archiving our file folders in 30 days of a issuance of a report. But like I said, if you look at our report right from start to end, everything is there in that. So even if it goes to an income tax officer or a transfer pricing officer or to an auditor, whatever it needs to be there for them to make that judgment call, it's basically there in the report. We never issue our Excel worksheets because that's kind of our intellectual property. But we ensure that our report is as detailed as can be.
So next questions, most of the questions regarding the betas there. How can you extract the beta and how can we go for a discounting rate? And third point is regarding the number of years. How can 3 years or 5 years projections can we take? These three or four.
Right. So generally speaking, 5 years is a good forecast period, the discrete forecast period that you should take. Generally speaking, it depends also on the cycle, right? I mean, if you have an industry like a classic example is, let's say, shipbuilding, right? So you probably be wanting to have more years of discrete projections. If you are doing a valuation for a mine, then we've actually worked with around 15 to 20 years of forecast for that. But generally speaking, for any business, around 3 to 5 years is a good number.
Okay. And what about terminal value, sir? It's long range companies like power generation companies and all. So end of the 20 years or 25 years, how to work on terminal value? Is the market value present or
Right. So what happens after 20 years, whatever the terminal value is, once you discount it back to today,
okay.
that value is very inconsequential.
Yes.
Because so think of it that because most of your valuation you would get over a period of this 20 years, and I would say first 10 years is the bulk of the value. Okay, unless and until you're having a lot of losses in the first so many years. But if you're looking at 20 years and the terminal value that you get over there, once you discount it, it will be a small number. But to answer that question again, you would look at the long term growth rate as of you look at how mining industries work. Basis essentially that's what you'll be looking at for 20 years, and you use that, and then you basically project your terminal value.
Yeah, like
Pankaj bhai,
and one more.
एक minute, Machar, with us today we are lucky to have our own Hyderabadi handsome looking singing guy and a true chartered accountant CPA from Dubai. I would request Abbas bhai to be called on screen. Rajesh, you are lucky to have Abbas bhai on screen. I am requesting him. Abbas bhai, you are here.
Hello.
Welcome, Abbas bhai.
Hi.
Abbas bhai, friends, I can tell you
Hello,
one
Abbas
thing
bhai.
is he is our own Hyderabadi, and we are waiting for his confirmation soon. For him to come and deliver a lecture to all of us. And a man who's written more than 25 books globally on IFRS and US GAAP. And the best part is a chartered accountant, homegrown in Hyderabad, and a very lovable heart. And I can't stop talking about him. Abbas bhai, if you can just, Rajesh bhai, with your permission, I think we are lucky to have him. Abbas bhai, Pankaj bhai, would you like to say something about Abbas bhai?
Would like to
अब्बास
hear
भाई के
from you,
बारे में
Abbas bhai.
मैं क्या बोलूं, दया भाई पूरा हैदराबाद उनको जानता है, तो if he can just say a few words about the thing because he has been listening, it will be great.
Yeah. Devai and of course Rajesh sir, with your excellent. I mean, of course you're the expert on this particular topic. With your permission,
Still
I
a
just
student,
wanted to
sir.
add a few things. Yeah. The COVID-19, especially now, the impact has to be assessed under international standards. When the auditor issues his report, he has to evaluate the going concern assertion, because either he has to say that there are material uncertainties, or he has to just give an emphasis of matter, or say nothing, depending on how he evaluates the management plans. And the management plans encompasses that, if you see under ISA 570, which is the standard on auditing, and under ISA 540, the auditor has to make the assessment of the management plans, and especially on the cash flow forecast for the next 12 months. Now, those forecasts are pretty much what you're talking about. When you talked about the valuations and the market approach, there are a lot of uncertainties that go in there, especially with the kind of the assumptions that you make under the present circumstances, wherein if you look at the world economy and you see what the economic conditions are, the downturn, um, you know whether it's going to be 10% lower, whether it's going to be 20% lower compared to the previous year, that's again an assumption. So if the management prepares cash flow forecast for the next 12 months and they presume that it's going to be 10% lower than the previous year, now the auditor will probably have to assess that, probably ask them to do like a stress test, to do sensitivity analysis, and probably look at the worst case scenario and the most optimistic, and go something between, in order to assess whether the company is going to be a going concern. Now, to take the most very famous example, Hertz Rent a Car, they went into bankruptcy. Now, this is the car company which has survived for more than a century. It even survived the Great Depression of 1930s, and with COVID-19, within a few months, it filed for bankruptcy. I mean, there are tons of examples. A lot of impairments are taking place in the oil and gas industry. If you see like how Shell has now come out with its second quarters and the first quarters, huge impairments are taking place. I think this calls for the auditor not just to look at the things that have happened in the past, which are reflected on the balance sheets, but I think they have to be ready to go and make an assessment of the future. Now, that according to me, it's something going way beyond than what the auditors have been doing in the past. So I think your session comes in very handy in these circumstances where you talked about the fair valuations, you talked about the cash flows that are coming out of the variant valuations. It's very relevant to the auditors right now, not just for valuation purposes, but even in talking about, making a report, or giving the audit report, and under the ISA, where they have to make the assessment of going concern. Otherwise, if they miss the board, if they do not actually capture these things in the audit report, they could be held responsible in a very big manner. There could be lawsuits coming out of it. So I think if you can throw some lights on how does the auditor actually assess the going concern? How does it look at the cash flow projections which are given by the company? That will be also a great value added. Thank you, Pankaj Bhai. It was just a very off-the-cuff remarks, a very personal opinion.
Thank you very much, and my apologies for not bringing you earlier because I
No,
was
no, no.
just busy listening to Rajesh bhai. ध्यान कहीं पे
Absolutely.
नहीं गया मेरा भी, but
नहीं,
sorry.
but Pankaj bhai,
And these are my very
आपने आप
personal opinions. These are not to be attributed to any organization I'm part of. These are very personal things. Personal opinion, basically. But Rajesh bhai, if you can throw light on that, it would really, really be value added for all of us.
Sure. So obviously, when we talk about the going concern assumptions, and I think that um, and we had this discussion with our audit partner Atul Deshmukh, and we also got in Mark Zaila, who is basically a very senior professional who practices in Atlanta. And this question which actually came up, Abbas bhai, thank you for actually bringing this up. uh, but I think that definitely most of the businesses have to relook as to whether this really affects their going concern. And on an audit standpoint, so let's say if I'm an audit partner and I am made to sign on this balance sheet, I would first thing what I will see is that, okay, whether I have an access to capital to to for allowing me to tide over this difficult time. Okay, whether I have an access to capital, how much of how much of cash really is with me to meet my operational expenses for 2 years, 3 years, 2 months or 3 months. And then if let's say if I don't have that cash, what is my other assets that can convert to cash, looking at your accounts receivable, looking at your balance sheet and making assessment as to how soon this could really churn out into cash for operational purposes. If that is not the case, if your balance sheet does not have those assets that can be readily converted to cash, then you are definitely looking at your borrowings, whether you have some kind of borrowings to kind of tide over. The businesses that we were talking about, there was this ice cream manufacturer, fantastic business model created over 5 years. they were basically paying almost 60% of the cost, but were doing almost 10% of revenue, sales of ice cream, right? But luckily they are a funded company, so they were able to draw upon their investors to kind of get that necessary funds infusion. Had that not been the case, there would have definitely been a question mark on their ability to continue in the foreseeable future. So I would say that look at your assets, what kind of you look at your balance as an auditor. I would definitely look at my balance sheet, look at the various assets and how soon can be converted to meet my operational requirement. If I have a drawal facility available where I can kind of dig into, I still have a saving space. If not, then going concern will definitely be impaired.
Absolutely. Thank you, Rajesh bhai. Just wanted to actually, add a few things, not on the technical side, but I think I've been following all the webinars that are happening at the Center of Excellence and the Hyderabad chapter. I must say that, I'm a chartered accountant from Hyderabad, of course, a CA, homegrown. Of course, most of my life lived abroad. But I think what I'm seeing now, it's it's something so motivating that, I mean, I feel like I should come back to Hyderabad to learn all these things. It's all being done by Daya bhai.
Most welcome.
Thanks to Daya bhai. He has been a great, what should I say, addition to the entire knowledge base of our side of the globe, which was probably done, but not so intensely. I mean, every day I would like to first see in the calendar what is being offered by the Center of Excellence, and I find something very interesting. So I must congratulate the Hyderabad chapter, the Hyderabad branch, and the Center of Excellence for the invaluable webinars that are being offered. And Daya bhai, you are definitely adding value, and please keep going. And let's do more of it. I think this is the need of the hour.
Yes. But Abbas bhai, one promise we need from you today, we got you on the screen, is only for one reason. We need one session from you also. And I think not from any technical side, but I think the journey you have gone through from, Lakdi ka Pul to US, from US to Dubai and to the world. I think that journey, I think experience which if you are able to share with youngsters, it is going to make a whole lot of difference. And more importantly, undoubtedly, you become big only when you have knowledge. And when you have knowledge and then you share knowledge. And you are one such person who have all across shared so many things. And, the kind of charity you do, I know well. And, this smallest amount of 2 hours of session of yours to motivate our youngsters will make a whole lot of difference. And honestly, Pankaj bhai, I can tell you one thing is I feel petite and small when I stand next to Abbas bhai, when I go and meet Rajesh. And there are such people who are really knowledgeable in every way, and they're like amazing. They just sitting and listening to them makes whole lot of difference. And I'm really lucky that I have friends, guides and brothers like them who are giving me a lot of motivation to do so many things positively. And Rajesh coming and talking in Hyderabad chapter itself is a big thing. Honestly, I'm telling you, because he has been a speaker across the world and he's been talking, where not. I can tell you, like, Tax Sutra and all, they invite him for delivering lectures, and it's basically a pleasure. And on one click of button, you could get Abbas bhai to Hyderabad again. What more we want? And having such kind of person will make a whole lot of difference. So thank you, Abbas bhai, for coming and joining and giving your comments. And Pankaj bhai, what we can do is this question answers, we can actually share it with Rajesh. As we do, we can take the feedback and his answers, and we can host it back, if you can see. Over to you, Pankaj.
Yes, thank you. In fact, it was वो कैसा breeze of fresh air था. Abbas bhai का ना, Rajesh bhai, only thing is you might not have talked in Hyderabad, but now मेरा life miserable हो जाएगा अगर मैं आपको और 2-3 बार नहीं लाया तो. In the way the chats, you would have seen the chats, you would have seen the comments. Of course, I shall also share the chat with you especially. And one of the best session, इतना जो नंबर है, एक नंबर भी कम नहीं हुआ. मैं देख रहा हूँ 2 घंटे, how 2 hours passed. Frankly, I don't know. It was just like we started the session 10 minutes back. And then when you pointed out, I thought it's only 30 minutes. Why is Rajesh bhai asking for time? Okay, then I realized the time is much, but that's excellent presentation. We can't stop all of you. Thank you, Abbas bhai, and as promised to that, I know about you. आप क्या है? बस छोटा सा गुजारिश है कि please come back and have one session for Hyderabad also. And Machara, thank you for taking up the questions and all. May I request Deepak to kindly propose a formal vote of thanks so that.
Dayabai,
Yes, na. Machar.
We need more number of classes and series of classes from Rajesh ji, because he's covered almost the basic points of valuation to the all vital points in valuation, like everything, non-operating assets and surplus cash, benchmarking and whatnot, everything has covered. So intangible assets, valuation standards, each and every module we need separate series, so that I'm requesting Dayabai and Pankaj Bhai to please coordinate with Rajesh ji to conduct the seminars in Hyderabad.
We have already received a long list from Rajesh that he has promised us to do. So let us start working for it.
Great, sir. Thank you. Thank you, Rajesh ji.
Thank you. Thank you so much. Really appreciate it.
Deepak, before you propose vote of thanks, in fact, Deepak bhai, you can start because we are just getting late. I'd just like to say thank you to Rajesh bhai also, but Deepak, you just start the vote of thanks. Okay.
I, on entire behalf of Managing Committee of Hyderabad branch of SIRC of ICAI, extend sincere vote of thanks to CA Rajesh Khairajani ji for his such a wonderful and electrifying session. Sir, believe me, the way you have touched the practical issues and the comparison of various methods was very, very interesting. I can only say that that experience of 500 reports and the assignments was bunched to us in 2 hours and presented to us in the most simplest way. As we all know, the growth of the Indian story is still unpacked. There is a lot of opportunity for us in valuation, and definitely this session will be go in a long journey and remembered by all the attendees. I sincerely thank P.A. Dayanivaji for again getting a super wonderful speaker to Hyderabad branch for the first time, and also request him for the following sessions. I also thank C.A. Abbas ji for his suggestions and looking forward to hear him at the earliest. Thank you, Rajesh ji. One and again, I also thank my Chairman Pankaj Kumar Trivedi and my colleague in the managing Machar Rao for his support in conducting this seminar. Daya sir and Rajesh sir, thank you once again, sir.
Thank you.
And Rajesh bhai, ये COVID times में बस इससे बढ़ के कुछ नहीं कर सकता था. It's a small thank you note from Hyderabad. Once it opens up, definitely this will be sent to you properly framed to your address in Mumbai. अभी तक तो बस virtually accept कर लीजिए इसको. अब्बास भाई के तरफ से आपको accept कर लीजिए बस उतना ही. Thank you very much. Thank you each and everyone. Thank you all the participants for being with us. Thank you Abbas bhai. Thank you Rajesh ji. Thank you Daya bhai. Thank you Machar. Thank you Deepak. And thank you one and all. Thank you.
Ayaji, the designer trendy and futuristic program. Thank you so much, and requesting you to do more programs for Hyderabad for the benefit of Hyderabad members. And like you,
Machar, so many programs we are doing now. People will tell you only knowledge, knowledge, knowledge. Get us work also.
अच्छे दिन आ जाएंगे.
But Abbas bhai,
जी
Abbas bhai, एक session आपका भी चाहिए Abbas bhai. It will be of
जरूर
great
sir.
help.
Anything for Hyderabad and for you. And Pankaj bhai,
Thank
so,
you.
we love your humor, sense of humor. So you add that the great sense of humor, which makes all the difference.
Thank you sir. Thank you.
Thank you, sir. Thank you.
आपको देख के थोड़ा थोड़ा सीख लेता हूँ सर. वैसे किशोर कुमार के गाने तो याद है. काश में कर सकता है. ठीक है.
Rajesh bhai, I think thank you very much
Anything for Hyderabad. I am proud to be Hyderabadi and of course proud to be an Indian. So anything there, bhai, anytime you need. Let me.
Thank you, Abbas bhai.
Thanks.
Rajesh bhai, thank you very much.
Thanks, sir.